market movers. This is The Pulse with Francine Lacqua.
Morning, folks. Welcome to the show. Fran's off today, but I'll be with you for the next couple of days. Then you've got Anna for a couple of days, but she'll be back soon, I promise. I just want to show you what is happening with the European chip story this morning. Plus, I want to fold in a little bit of Apple. We've got pre-market trade now starting in the United States. Chips are generally reasonably well bid, as you can see. ASML, STM, Infineon, BE, all trading nicely to the upside this morning. Let's take a quick look at where Apple is pre-market as well, just to give you an idea of how that's being folded, that story is being folded into the United States. We'll get that brought up in just a second. Basically, what has happened over the weekend is we have ended up with an exemption for the smartphone sector, for the chip sector, but that's not going to be permanent. Lutnick comes out over the weekend and basically says this is not permanent. Then Trump comes out and basically says nobody is off the hook. This is what he had to say on Air Force One.
The tariffs will be in place in the not-distant future because, as you know, like we did with steel, like we did with automobiles, like we did with aluminum, which are now fully on, we'll be doing that with semiconductors, with chips, and numerous other things. And that'll take place in the very near future.
What rate the semiconductor tariff?
I'm going to be announcing it over the next week.
Potentially as early as today. Let's get a take on this from Bill Fabrice, who's going to walk us through all of this. Bill, we get a relief rally because there is an expectation that actually maybe these tariffs are going to be lower than the 145 that's being applied to China. But do we know how much lower, and do we know how long it's going to take to get there? What do we know at this point, and what do we not know?
Well, yeah, after this last week when we've seen these things come into effect and then get quickly reversed, the administration is really pushing back on the idea that it's stepping away from this strategy of tariffs. So, yes, consumer electronics, things like those iPhone and Samsung imports into the United States, they're not going to face that 145% tariff now and maybe never. We just don't know. What the administration is saying now is that they're going to create a special bucket for those kind of products that have semiconductors. They're going to look at having a special tariff applied to those kind of goods. Howard Lutnick saying that there will be some sort of an announcement in the Federal Register perhaps this week, perhaps today, we don't know, that talks about what those tariff levels would be and what the timeline is. That timeline would be expected to be a couple months at the earliest. And that would allow a lot of time for feedback from companies and a lot of time to lobby. We do expect some kind of tariffs based on what President Trump is saying, but we certainly don't expect them to be anywhere near as high as 145%.
What do you do if you're a corporation? What do you do if you're a company? What do you do if you're a business that has a supply chain? We're being whipsawed here at the moment. What are we hearing from the companies that actually have to use this kit?
Yeah, I don't think the volatility is going to go away in the short term, but I think you're going to see more of what we saw in the days and the weeks leading up to the reciprocal tariff deadline last week, which was companies are either trying to rapidly get their products into the United States and perhaps stockpile, build up some inventories that can provide a little bit of a buffer for them, or we've seen companies suspending orders, pausing until they get a little bit more certainty. That's certainly something that the smaller companies have been doing. So I think it gives them more time for that. We know Apple has looked at, for instance, looking at pushing more iPhone supply through India. It can't replace the entire U.S. market from its supplies in India, but it can certainly push more iPhones into the States in the coming 90 days or 60 days or whatever they think they have until new tariffs come into place.
Bloomberg senior editor Bill Fabrice, thank you very much indeed. That's the kind of U.S. side of the fence. Let's talk about what is happening in Asia right now. The Chinese President Xi Jinping touching down in Vietnam. Obviously, he's on some sort of a tour to garner support as China figures out how to deal with what is happening with the tariffs. So remember, everybody else got a tariff pause. China didn't. So we've got this trip now to Southeast Asia. He's looking for alliances. Is he going to find them? And is he going to find them in Hanoi? Let's get an answer to all of these questions. Bloomberg's China and Economy government editor Alan Wong joining us now. Talk to us about what are the wins that Xi Jinping is looking for here? What is the objective of this tour?
Yeah, so President Xi Jinping of China just landed in Vietnam a couple hours ago. This is coming just a couple of days after Trump gave everybody else a pause on the massive tariffs that he imposed, calling them reciprocal tariffs. But China didn't get that, and then the tariff level is at 145%, which we expect to wipe out basically virtually all trade between China and the U.S. Well, what does Xi Jinping want from this trip? First of all, it's not necessarily about gaining, it's about defending, because we know the Trump administration wants those three Southeast Asian countries, Vietnam, Malaysia, and Cambodia, to help in its fight against China, specifically to prevent the transshipment of Chinese exports through those countries into the United States, which is a way that the Trump administration thinks amounts to dodging the tariffs. So what Beijing would want from this trip is to make sure that its neighbors doesn't sell it out for a better deal with Trump. We know that all three of those countries are actively seeking to negotiate with Trump for a deal. So the baseline expectation for Xi Jinping would be that they do not settle their dispute with Trump at the expense of Beijing's own exports.
Alan, thanks for the update. We'll watch for headlines. Alan Wong joining us on what Xi Jinping is hoping to achieve this week. So in terms of the market perspective on all of this, dollar a little bit lower, down for a fifth day. Donald Trump downplaying his exemption on the technology sector. That seems to be causing a little bit of volatility. European equities, though, broadly catching a bid this morning. US futures are in the green. So you've got a mixed asset story. Paul Quinsee, Global Head of Equities at JP Morgan Asset Management, joining me around the table. Are we heading for another week of volatility? Does it kind of feel like that?
Absolutely. So I've been doing this 40 years now. Last week was right up there.
Yep.
Some of the wildest times we've seen. It's hard to believe it now. The S&P was up 6% last week. Yeah. And twice within an hour, on Monday and Wednesday, we had a year's worth of returns, an 8% gain. So we've seen a lot of volatility, but of course in both directions. It's not going to end right here. But hopefully, as time passes, investors start to get a bit more sense of what's going on, a little bit more confidence in starting to think about how to price stocks again.
I'm assuming we need to wait for earnings season to be over before we get that. And the problem with the earnings season story is it's going to deliver, I suspect, not much guidance. So that clarity maybe you're talking about, is it going to come from corporations? And if we don't have that guidance to price stocks, how accurate is our stock pricing? Yeah. So sure, the companies are still trying to figure out what's going on to recalibrate, and they've got to think about two things, right? The direct hit from the tariffs, the impact that has on their businesses, which in some cases is very significant. We were just talking about some of those. In other cases, much less. And then the broader impact of probably a more challenging economic environment they're going to see for a while than any of us were expecting until a couple of weeks ago. And that's going to have broader impact across the whole corporate sector too. So I think the key thing in the earnings season, how are companies reacting? They're probably going to post pretty good results for Q1. We think Q1 was solid, but it's all about what they do next. Do they suspend their guidance? We've seen some of that. Do they start to step up a little bit and talk about buying back more stock, which is a tool that's always available to companies, of course, in uncertain times. A lot of companies were perhaps holding back a little bit there because the prices were high. Well, now prices have moved more in that direction. So just passing through all of that is certainly what our investors are going to be spending time on in the next few weeks, looking for clues and looking for opportunities. You don't need certainty to buy stocks. You find good companies at lower prices, you're going to get some great opportunities. But are there better opportunities further down the road? Does the volatility produce greater volatility? Is there a temptation as an investor maybe to hang on to cash right now and think about and hope for maybe better opportunities to get in at a later date?
Always tempted to do that. But timing the markets...
Sure.
Very hard.
You're going to tell me that you should stay invested, but people are beginning to question that right now.
Right. Look, the advice we give on that, over time, equities make you money, right? Most of our clients make most of their money in the stock markets. But the returns don't come smoothly. They don't come easy. So first of all, every year you've got to expect some volatility. We're in the pits of that right now. Secondly, if you look back over the last 20 years, the 10% return you've had on owning stocks in the US drops to 6% if you miss the 10 best days. Sure. So that's 1 day in 500. And we've already seen a couple of those just in the last couple of weeks. So it's hard to do.
I get that, but there are key moments in time. So 1929, you get the crash. It takes until 1954 to get back to where you were going into the 1929 crash. 2000, the market comes down. Takes another, 7 or 8 years to get back to where you were. So I hear what you're saying, but are there moments in time when that doesn't apply?
I do think there are things investors can do to help through this period, right? So I think this year, more than ever, paying attention to some of the sort of time-honored principles. Diversification is your friend.
Yep.
That's never more true than when things are tough. And then valuation matters as well. And thinking about having a truly diversified portfolio with valuation on your side, that's an important thing to do. And I think it's particularly important right now after a decade in which the returns in equity markets have really come from sort of one place, right? The best growth stocks in the US. And those are still amazing companies, but I think you want to think about a more diversified approach from here.
Geographically?
Two things. Geographically,
yep.
I think Europe earns its place in the portfolio from here.
Right.
So it hasn't for a long time.
Yep.
Right? European stocks have underperformed US stocks by 7 percentage points a year for the last 15 years. Most of that's come from lower fundamental earnings growth.
And that valuation gap's going to close, you think?
But the valuation gap has now opened up and is wide enough that even if, in our assessment, if American companies on average continue to grow more quickly, and they probably will, then you're paid enough to invest in Europe too. So European returns can be competitive because the valuation starting point is so much lower than it used to be. And the other point, and I mentioned value too, the best returns have come from growth investing. We know that. But over long periods of time, value's been your friend as well. Value's been making a bit of a stealth comeback here in the last couple of years. Value's been working in Europe. Value's been working in Asia. Only in the US have we not seen that. In the first quarter, value stocks actually up 2% in the US compared to growth stocks down, 7 or 8, something like that. So are investors evenly balanced between growth and value, as I think they probably should be? Maybe some of them have had a lot more money in growth over the years and need to pay attention to that side of the portfolio again as well.
Also in a diversified portfolio, what else am I putting in there? Gold. What else goes into that mix to diversify me against what is happening at the moment? A lot of people clearly are looking at gold in a way that they haven't done for quite some time. Treasuries normally acted as the ballast on the other side of the portfolio. Do I need to... Is the ballast different and more diversified in this world that we're in now?
Yeah, so look, in our team we focus on trying to we follow about 2,500 companies around the world, so we just try and make the most of that. I think much as I love equities is never going to be all your exposure, but I think it remains the core.
Is it difficult to the relationship between bonds and bonds and equities? How are you on the equity side of the fence seeing that right now?
Yeah,
as you try and value stocks, what kind of discount rate are you thinking about going forward?
Yeah. So the most important... So what we really watch from the fixed income markets is signs of credit stress, right? That's the thing that we've learned in previous crises is a very important warning signal for equities that are kind of exposed to that. So far, that's been reasonably benign. We've seen, obviously, some rising credit spreads around the world, particularly in the US, but that isn't sending us those kind of super warning messages yet. So we've got a close eye on that, but it isn't telling us anything too bad at this point.
So in terms of the kind of the bigger picture at the moment, your attitude would be diversify your portfolio, keep diversifying your portfolio. Does that in theory, therefore, just implies flows out of the United States? Is that something that... And how long does that last for? How long do you think it's going to take before we get to a point where actually most portfolios are more balanced? Yeah. So everyone's starting point is different, right? It's very hard to call that one. There are going to be people, we've read a lot in recent years about this enormous amount of cash sitting on the sidelines. Yeah. It's all there. And I think some of this is going to be addressed by, as people think about putting money to work in these markets, trying to take advantage of lower prices, thinking about where they put it, not just always going back to the same 7 names that have driven all the attention over the last... I don't know why people use Magnificent Seven, by the way. In the movie, only 3 of them survived, so it's not a great lesson. We're not going to pick which ones are going to survive this time around. But is the volatility at the moment just telling people broadly to take more risk, to take less risk? If I'm a portfolio manager, if I'm a trader at the moment, I've definitely got a risk manager tapping me on the shoulder going, reduce your risk positions right now. Is that something that investors more broadly should take on board as well? Is this an environment to take less risk?
The first thing you've got to do in environments like this, and we've learned this in previous crises, is make sure you're not overly exposed, right? And fundamentals have changed for some companies. Making sure that you don't own too many of those, that's what people were doing kind of early last week. But I think we're through that phase now. We've found that some of the best opportunities for stock picking have come in the aftermath of crises, right? So 2009...
Are we in the aftermath yet?
Probably not there yet. But we're heading there, and we're closer than we were a week ago.
Yes.
But just remembering that. So post-GFC, 2021, after Pfizer Monday, and as the fog cleared a bit from COVID, owning great companies at great prices, there are some fantastic opportunities
Is it
to come
easier,
from that.
but is it more difficult when you've got such key man risk in Trump? Is it how much harder does that become? In as much as you just don't know where the volatility is coming. I can price risk, I can see those risks, I can understand those risks. But when you have something as idiosyncratic as Trump and the effect that he's having, can I make those same sort of valuation judgments in this world?
It's always hard. So think about the aftermath of COVID. We didn't know what was going on. We hadn't lived through a pandemic. In hindsight, it feels okay because that volatility's gone away. We just look at the fantastic returns that followed. But it's always really, really hard at the time. And there are always compelling reasons not to invest and not to take risks.
You also had the Fed pushing liquidity into...
You had that too. But staying focused on company fundamentals and the prices you're paying, that is the best thing you can do.
Great to see you, Paul. Thanks for stopping by. Lively discussion. Paul Kines, Global Head of Equities at JP Morgan Asset Management. Thank you very much indeed. Coming up, we'll talk about one subsector of the equity space. European chip stocks certainly on the rise this morning. This after President Trump exempted certain electronics from the current tariffs, but not for long. Nobody apparently is off the hook. We're going to talk about that story next. This is Bloomberg. Past the hour, European equities are higher this morning. Chip stocks are leading the charge. This after we saw the move out of the administration over the weekend to exempt smartphones and other tech imports, though apparently not for long. Peter Elstrom joining me around the table to talk us through all of this. We know that there were very high tariffs. We know that they were exempted. We know that that's not going to last for long. We just don't know what we go to ultimately. What do we know about where we go to ultimately?
Well, there is a lot of uncertainty here. What we found out late on Friday night is that certain products are going to be exempt from that 125% tariff from China into the United States. And a big deal was made out of that. Apple in particular, some of the other companies that are playing in this space breathed a big sigh of relief that they were able to get this. But very quickly, the Trump administration came forward and said they're not completely off the hook here. That 125% tariff may be off the table at this point, but they're going to begin a process to look at what kind of chip tariffs are going to be implemented right now. So it's not like the iPhones, the Mac laptops, et cetera, are going to be exempt from these tariffs. We just don't know exactly what they are going to be. So I think what we're seeing in the market in Europe and probably in the U.S. after this is a sigh of relief that these tariffs are not going into effect right away. They're probably not going to be as high as expected, but we don't know what they're going to be. So companies are having a hard time making decisions at this point about what their strategy is going to be if they have this much uncertainty.
You and I were chatting a little bit earlier, and I was posing a question to you about why TSMC started the session in Asia and Taiwan up and then faded.
Right.
Have we figured anything out?
Well, we have some hints of a solution at this point.
Do you know what's to rely on, Peter?
Is Hanhai, of course, is the most important manufacturer for Apple and the iPhones right now. We saw them jump quite a bit after this news, and they remained up. So they're up quite high. They finished the session up more than 3%, as I recall. Now, TSMC is in a different position. They make the chips for Apple and the iPhones, and they also make chips for NVIDIA. What they're trying to do right now, though, is build a bunch of factories in the United States. It does look like when they buy chip-making equipment from companies like ASML, Tokyo Electron, Applied Materials, they're going to have to pay tariffs on that. What we saw from the Trump administration over the weekend is an exemption that signals later on that chip-making equipment is going to be subject to certain tariffs. Again, we don't know exactly what that's going to be, but it wasn't clear because it's been so important for the United States to rebuild some of its chip-making industry. It wasn't clear that chip-making equipment was going to be subject to tariffs. Now it looks like they probably will be.
You can always rely on Peter for a smart answer. Thank you very much indeed. Peter Elstrom joining us on what is happening in the tech space. Let's move on and talk about what is happening in the financial space, the banks in particular. So we had JP Morgan out with numbers Friday. Later today, we get Goldman Sachs. We obviously had Wells and JP Friday, Morgan Stanley out as well. We learned a lot at that point, but it's going to be really interesting to see what Goldman Sachs has to say a little bit later on today. Let's talk about the earnings call, though, with JPM. Jamie was on that call. Jamie Dimon was on that call, warning of market turbulence heading into this earnings season. Ted Pick was on the Morgan Stanley call. He's talking about saying the firm doesn't actually know yet where all this trade story is going to settle.
You're going to hear 1,000 companies report, and they're going to tell you what their guidance is. My guess is a lot will remove it. They're going to tell you what they think it might do to their customers, their base, their earnings, their costs, their tariffs. It's different for every company, but I assume you'll see that. And anecdotally, a lot of people are not doing things because of this. They're going to wait and see.
As the year progresses, markets will calibrate further clarity on trade policy against the tax and deregulatory pillars of the agenda as the U.S. endeavors to rebalance the fiscal equation and assert the national interest. Given this unpredictability, some clients are deferring strategic activity while others are proceeding.
Ted Pick, Jamie Dimon. Charlie Wells is here around the table talking about the banking sector. What do we know so far? We're going to get Goldman Sachs a little bit later on, but what was the takeaway Friday?
I just thought of a pun. Can I share it with you?
Yeah, go.
Cautious optimism. That's what I'm seeing here. So Ted Pick talked about how we're seeing a pause, not a delete on the deal front. And if you go back and look at those earnings transcripts, which I would really encourage people to do, and watch out for the blogging on Goldman today, there's this kind of sense of optimism here. And it's pegged to this idea that if the Trump team can get this trade issue resolved quickly, things are going to be okay, right? The deals will come back. They're just shelved for now. They will come back. The consumer's going to be okay. I'm calling it cautious optimism.
Yeah, realistic optimism, I don't know. It doesn't feel like that's the message coming out of the Trump administration right now. So what is Goldman's going to tell us today?
So look, they're probably going to have really good news from the past. So on that equities trading that we saw so much volatility. That's always good for them. But it's about deals, right? Again, it's like they are just so exposed on that deal front. What do they get there? And I think another issue that we really should be paying attention to is wealth management, because Morgan Stanley missed on that front. And it's looking like it's not going to be amazing news for Goldman either. And I think this is the question that a lot of analysts have. Wealth is good, I mean, in a lot of ways, but it's good in turbulent times, right? Because you get those fees coming in no matter what's happening. But if they continue to miss, what's going on there? What happens if we get into a more turbulent time?
Do we get any clues as to why?
I mean, there's some theories about asset mix, right? That clients are going more into these kind of like less fee-generating assets. That could be a part of it. But I think we're going to see maybe if there's more analyst questions on this, because if you get this kind of pattern forming, what's happening there?
We're going to watch very carefully a little bit later on. Charlie, Shanali, all the great team lined up to work our way through these banking earnings. We'll have that for you a little bit later on. Coming up on this show, though, the EU racing to clinch deals around the world, trade deals around the world. Obviously, it's seeing relations with the United States soaring. We're going to look at what the bloc is going to be focusing on this morning. We'll do that next. Monday morning, good morning. Welcome to The Pulse. I'm Guy Johnson. Let's talk about your top stories this Monday morning. European stocks and US futures are rising, despite President Trump pledging tariffs are still coming on smartphones, computers and other electronics. Apparently he's saying that no one is off the hook on this matter. The dollar is also under pressure, the greenback falling for a fifth day to a 6-month low as the tariff saga rolls on. Plus, the Chinese President Xi Jinping heading to Southeast Asia as he looks to form alliances in the trade war with the United States. Let's talk about markets. Let's talk about kind of where we are this morning and figure it all out. At least for now, for the next 5 minutes. Who knows what's going to happen 5 minutes down the road. Let's start with the European Union, actually. It's racing. It's trying to figure out if it can do deals around the world to try and offset some of the turbulence it's seeing, particularly with its relationship with the United States. How feasible is this going to be? Maroš Šefčovič is going to be in the United States a little bit later on. Let's get a sense of how these negotiations are going. Ollie Crook joins us on this matter. Ollie, give us an update.
Yeah, so Guy, what the Europeans are really aiming to do is to negotiate trade deals, as you're alluding to, around the world. There was a Mercosur deal that was struck at the end of last year, sort of tentatively. The French and some others had some notable issues with it to try to get it through. But these are the kinds of things, the uncertainty around the Trump proposals around tariff, that really put pressure and accelerate these deals getting done. We've had the EU also talking about a free trade agreement with the UAE. These are all the sorts of conversations that I've been having over the last week with finance ministers and trade ministers trying to reevaluate the landscape. But the main deal that everybody wants to strike, Guy, is with the United States. That is still the primary objective of policymakers here in Europe. You have Maros Sefcovic, who's going to be in D.C. today to have conversations with his counterparts to try to get his head around and try to get the European head collectively around what precisely the Trump administration wants out of Europe, other than just closing this trade barrier. We also have the question of Giorgia Meloni. She'll be there on Thursday as well to talk with Donald Trump. And when you think about the sort of all the leaders and all the people who've tried to get an audience with the Trump administration, I managed to catch up on Friday with the president of Switzerland, who actually managed to have a call with with Trump on Wednesday. Right before that, have a listen to what she had to say.
I could explain that to the US president, which was very helpful. And we also talked, of course, about the tariffs and that, of course, we are unhappy about 31%, which is huge. And so we would like to talk about how, in fact, we can come back to a normal basis of tariffs together. And we both agreed that we have to find a solution.
So she managed to have that conversation with Donald Trump last week, saying that some of the points were getting through. She was making the point that basically Switzerland has a huge economic trading relationship with the United States, not just in the exports, but all the R&D. Apparently, Switzerland and Swiss companies are the #1 spender in terms of R&D in the United States. And then over the weekend, you hear from companies like Novo Nordisk who are saying they're actually now willing to plow $23 billion into the United States over the next 5 years. Are those the kinds of deals that really cut through to the Trump administration and kind of guarantee trade negotiations? Again, everybody's going to try to model their own negotiating tactic in terms of what other countries can secure.
Ollie, great stuff. Thank you very much indeed for the update. We'll look for some of those, look for some of the news out of some of those talks a little bit later on. Let's talk about some of the other stories we're watching this Monday morning. UK officials are rushing to secure the raw materials needed to keep Britain's last primary steel manufacturer up and running, British Steel. The government passed an emergency bill Saturday to take control of the steel maker after talks with its Chinese owner broke down. The UK Business Secretary, Jonathan Reynolds, spoke about the takeover from an emergency session in the House of Commons.
Since taking office, this government has been negotiating in good faith with British Steel's owners, Xinye. We have worked tirelessly to find a way forward, making a generous offer of support to British Steel that included sensible, common-sense conditions to protect the workforce, to protect taxpayers' money, and create a commercially viable company for the future.
Situation in the UK. Euro area inflation will turn out slower than previously forecast because of higher US tariffs. That's according to a Bloomberg survey that supports the case for the ECB to cut interest rates this week. Some economists predict further cuts in April and in June. Isabelle, Mateos, Lago, Chief Economist of BNP Paribas, joining me around the table. Good morning.
Good morning, Guy.
So what does the ECB do this week? What should the ECB do this week?
Well, they're going to cut.
Yep.
But the most important part is going to be the narrative around that, the signal, any guidance that they can give to the future. Until recently, there was seemingly a debate amongst the members of the Governing Council as to whether what would dominate would be the deflationary impact of the US tariffs or the supposedly inflationary impact of retaliation from Europe and others. I think at this stage it's overwhelmingly clear that the deflationary impact dominates, so they're going to cut. But I think there are still going to be probably some saying, but you need to keep in mind all this stimulus coming from the German fiscal spending, etc. Now, realistically, that will come on stream much further down the line. So I think they should also make clear that if things continue on the path they're on, they're likely to cut in June as well, and that right now the overwhelming concern is growth and the disinflationary impulse. But hopefully they can provide that sort of guidance.
Let's assume that 2 is neutral. Do we go below 2?
Well, that's a big assumption. We don't know if 2 is neutral. And frankly, in the near term, with all the uncertainty that is in the environment right now, you could even argue that maybe it's lower. So that's something else I need to take into account.
So how far do you think ultimately they could go, though?
Two seems like a good level, because I think it's remarkable how Europe has been getting its act together, responding in a way that supports domestic growth, trying to do trade deal with others. And so I'm not too worried about a bad growth outcome for Europe. In fact, I think we're going to see a continued strengthening of growth in Europe, and that too is going to be the right floor.
Does the fiscal that we're seeing, particularly out of Germany, offset the uncertainty that we're seeing out of the United States?
Ultimately, yes, but exactly, how it, the uncertainty is right now. The German stimulus is going to be over the next few years, and so I think certainly 2025 and right now in 2025 is tough, and probably the downside, the headwinds dominate. But as you go out in time, all the positive impacts of the German stimulus, of the European defense stimulus, and the structural measures are going to compound one another, and so I'm actually quite optimistic for the growth trajectory of Europe between now and 2027.
Do you think the uncertainty, though, will cause European corporates to invest less? Why would you invest right now?
Well, right now it's not so much why would you invest, but where and how is just really complicated. But it seems to me that ultimately you're going to want to invest in the place where you have most certainty about the policy path and the growth path, and that's Europe more than the United States right now.
You could make the argument that you invest in the United States, because if you invest in the United States, you do have policy uncertainty. Once you're there, policy uncertainty is significantly lower.
No, once you're there, it's also very high, because the tariffs come in one day, come out the next day. You have no idea what are going to be your financing costs, because, there's all the financial volatility that there's been. Right. So I would disagree with that.
OK. So how much of an effect is... So the bond market's all over the place, financing costs are all over the place. How big an effect is that having? Because that has there's a gravitational effect out of the Treasury market into Europe as well.
That's very clear. And in fact, you could argue that this has been, if it continues, it's going to allow Europe to finance its stimulus at a much lower interest rate than would have been the case otherwise. Last week, the Treasuries, the 10-year went up 40 basis points. Yep. Typically, and even as recently as back in January, when that happened, European rates went up by more or less the same amount. Last week, the German bonds were pretty much stable. This is extraordinary. Yeah. This is telling you there is a lot of capital coming from the US to finance this extra European spending.
That comes with a cost of a higher currency. Is that going to be a headwind?
I'm not sure. Right now, that's another point for the ECB to consider. Yeah. It's making energy imports and all other imports cheaper. So I would say it's a plus right now.
So if you're getting a deflationary narrative, that enhances that deflationary narrative.
It enhances it, but it also, in the near term, it helps the ECB make that extra cut that the economy needs, and probably also the June one.
Isabelle, great to see you. Thank you very much for coming to see us. Isabelle Mateos, Lago, joining us from BNP Paribas. Let's turn our attention to what else is happening in the world. My favourite story of the morning, 14 years of trying. It's been a decade. It's been a long decade. Rory McIlroy has realised his lifetime ambition of achieving golfing immortality. He won last night at Augusta. It was pretty dramatic. So at around midnight, he drops a shot on the 18th. It gets really tense at that point. Rose is on the practice ground. We then get a playoff with Rose. They come down the 18th. Justin Rose doesn't manage to keep the momentum he's had in his incredible round, and Rory sinks to his knees. He's finally won a green jacket. An amazing night, I have to say. I'm feeling a little bit worse for wear this morning, having got up in the middle of the night to listen to all of that. Anyway, congratulations, Rory. Well done. Finally, the green jacket for you. OK, we're going to carry on the conversation around the markets a little bit later on. We'll talk about what is happening with the oil markets as well. We'll do that in just a moment. This is Bloomberg.
His agenda can be summarized as prosperity at home and peace abroad. Lower oil prices help both of those. And the peace abroad that's of most concern right now in the region where I am, in the Middle East, is Iran. During the Biden administration, oil prices were higher. There was sort of an appeasement attitude and no strong enforcement of sanctions. Enormous funding to Hamas, to Hezbollah, to the Houthis, and a rapid advancement of their nuclear program. President Trump's agenda is exactly the opposite of that. It's peace through strength, but we simply cannot and will not accept a nuclear-armed Iran.
Well, when it comes to Iran, we saw even more sanctions on the regime yesterday. When it comes to these oil sanctions, the president has said he wants to go back to maximum pressure. Is that part of the conversation you're having with Gulf allies on this tour, that they'd be willing to step in if some of those Iranian barrels come off the market?
Well, fortunately, just from the United States production itself and the size of the global oil market today, absolutely we can tolerate squeezing out Iranian exports. And of course, do all the Gulf neighbors want the same thing we want? Yes. Do they fear a nuclear-armed Iran? Absolutely. Do they think now is the time to turn the screws and end Iran's nuclear weapons program? Absolutely. But yeah, can the world tolerate that? Absolutely. 10 years ago, 20 years ago, could this have happened? No. But today we both have large American oil production, better relations with our neighbors, and a strong, resolute leader. In 40 years of trouble, 45 years of trouble from Iran, we've never had a better chance to reduce Iranian power, reduce Iranian tyranny in the Middle East, and we don't want to miss that opportunity.
Mr. Secretary, the president has said a lot, even recently to me on Air Force One. He likes that oil prices are coming down. Do you and the president have a price in mind?
No, I think my whole life I've avoided predicting prices or dictating prices. You know, we have a wonderful free market economy. That's what makes the world wealthier. That's what allows consumers to continually re-express choices in every direction. So no, there's no formula for a good oil price.
AMH in conversation with the U.S. Energy Secretary while in Abu Dhabi. A Middle East tour taking place at the moment as we see the conversation over the weekend, obviously focusing on Iran and the talks that have taken place there. Iran talking about the fact that those weekend talks delivered constructive conversations. The Saturday meeting, remember, was the first top-level meeting between Washington and Tehran since 2022 and definitely marks a renewed effort to resolve a standoff over Iran's nuclear program. Let's bring in Bloomberg Horizons Middle East and Africa anchor Jumana Basetchi. What do we get out of this weekend, Jumana?
Yeah, well, in terms of what we found out about the deal, not a whole lot. But just to point back to what you were saying there, both sides have said that the discussions were constructive. So that's a good start, I would say. And the fact that it even took place shows some improvement in the relationship in terms of where we were just a couple of months ago. And to be clear, there had been a lot of debate going into this about whether the talks are going to be direct or indirect. But what we got at the end of the day was the Iranian foreign minister having these meetings alongside the U.S. Special Envoy to the Middle East and Special Advisor Steve Witkoff. They weren't sitting in the same rooms, so they had 2 hours worth of discussion sitting in separate rooms, but they did speak to each other and greet to each other at the end of those discussions. So both sides have said that the conversations will continue. But at crux here, U.S. want to ensure that Iran don't actually develop a nuclear weapon. And from Iran's perspective, they are looking for sanctions relief. This is an economy that is crippled. The currency has massively devalued. There are shortages in oil and gas and food. And so they're really coming at it from a very weak perspective economically. But at the same time, the fact that the conversations are continuing does suggest that they have stopped short of what Iran called a red line, i.e. some more hawkish members of the U.S. administration, Israel, have been calling for a full dismantlement of Iran's nuclear program. They have said that that is a red line for them. And so what we can sort of piece together and glean from the fact that the conversations are continuing is at this point the discussions are about no further nuclear enrichment and possible more stringent monitoring of their enrichment program. And I should just say also that the IAEA recently put out a note suggesting that they have actually enriched nuclear material to a sufficient enough point to produce 6 atomic weapons within months. So they are very close to that threshold. And of course, much closer than they were back in 2018, which is when President Trump pulled the U.S. out of that original nuclear deal with Iran.
So is there, just in terms of what happens next, Iran is close. Does it basically try and draw these talks out, or is the need for guaranteed sanctions relief so important to it that it's prepared to do a quick deal?
Yeah, so I think, people that we speak to in the space say that it is in their interest to keep these talks going for as long as possible. And also you have to bear in mind that on one hand, yes, the Trump administration is engaging in discussions, but on the other hand, they're also waving a stick. They've talked about this maximum pressure campaign against Iran, about the possibility of even obstructing or applying more sanctions on their oil exports. And by the way, Iran is still producing 3.5 million barrels of oil per day. So we haven't actually seen the impact on the oil markets yet. But to what I was saying earlier, very important for them to get sanctions relief. And we just heard from the Iranian Foreign Ministry about half an hour ago, they saying the guaranteed U.S. sanctions relief is extremely important. In terms of what happens next, the foreign minister is going to Moscow later this week. So interesting there to see what happens from the Russia-Iran perspective. You've got to think that there are some background discussions taking place there, too. And then both sides have now confirmed that there will be more discussions taking place on April the 19th. It seems as though this time around the discussions will take place at somewhere in Europe. Vienna or Rome are some of the cities that are being put forward. But the conversations are ongoing. And if they don't lead to anywhere, then, of course, there is still that potential threat of maximum enforcement, maximum sanctions, and even the, so to speak, nuclear option, military action against Iran.
OK, we're going to watch the space very carefully. Thanks for the update. Jumana Basecci joining us out of Dubai. Let's kind of think about where we are with this week and where ultimately we're going. We're coming into a week where we have turbulence already around what's happening with tariffs around technology. We don't know ultimately where that is going to go. It's likely that we're going to see a lower rate than the 145 that is being applied broadly to China. But if you take a step back and think more broadly, it does seem as if the United States is basically trying to pursue some sort of economic containment of China. Now, the question is, does that spread out into something more significant? Remember Kennan? Remember the start of the Cold War? Is that kind of where we're at? Because that's the kind of language that Scott Bessent, the Treasury Secretary, is using right now. Let's get a take on this with Fabrice Pothier, Chief Executive at the Rasmussen Group and former Director of Policy Planning at NATO. Fabrice, Clausewitz often talks about kind of the interplay between what happens on the military and what happens basically with the economy. I simplify. But are we seeing that at the moment? At the moment, it looks as if the United States is trying to set up a Kennan-like containment of China on the economic front. Is that how you see it? Ultimately, where do you think policy is going to take us from the United States?
Well, if that's the intention, I think that's not going to be the outcome. What you're seeing right now is that you are seeing a kind of rapprochement between China and the European Union, because both are being squeezed, China harder than the European Union by the Trump administration. And they see that at the end, they have to turn to what is the next best economic partner. And the European Union is obviously a very important market for China. And China is a very important manufacturing base and market also for the European Union. So actually, if this is the intention of the Trump administration to contain China, they're making China actually more resilient in terms of its global economic position, because over the last few years, what you have seen is the EU kind of following to a certain degree the US policy of containment towards China. And what you're seeing now is cracks in that alignment, and with the EU being much more, I would say, independent-minded. And there will be normally an EU-China summit in next month, and we might see actually that rapprochement taking full daylight.
So you don't think that Europe is going to have to pick sides?
Well, Europe doesn't like to pick sides. But clearly Europe will have to go for its own interest. And the problem with the Trump tariff war is that it doesn't leave much choice in terms of where do you go? And you have to go with a more European-focused security and defense policy, and you have to go with your best next economic partners. And these are obviously starting with China, but also Japan, Canada, and a few others. So I think Europe is now going for, what's the best next option after the United States. So it's not about choosing, it's about surviving. And I think potentially, like one of your interveners was saying earlier, this could be good on the long term for Europe.
Do you think Europe is playing the China card because of what the United States is doing, because of what the United States wants? Yeah, we might talk to those guys over there if you don't give us a good deal.
I don't think that is that sophisticated and that united. I think it's more that there are some pro-China voices in Europe, mostly from economies like Italy or Spain, or to a certain degree France, who have always been in favor of a better engagement with China. And now they are seeing that there is more daylight between the EU and the US, and therefore arguing for this rapprochement. And again, this is out of economic necessity. If you look at the automotive sector in Europe, this is a sector entering a deep recession, a structural problem about not having taken on the electric vehicle curve. And the Chinese are really ahead of that. So you see a lot of pressure coming from the automotive industry in Europe to argue for better and closer alliances with their Chinese counterparts.
So this isn't a... We're not heading into a bipolar world. This is still a multipolar world that we're going to be operating in.
Exactly, but you will see, I think, a redistribution of what we have seen for the past decades with, for example, a weak dollar, a high level of investment in the United States, and relatively low tariff. Now you have a US that is heading towards a stronger dollar, but possibly lower investment and actually higher tariff. And the EU actually could recalibrate by finally having a stronger currency, more attractive to international investors, bigger investment, especially from the private sector, and possibly slightly higher tariff on certain goods, especially with the United States.
Is everything on the table? A lot of people are speculating about whether or not Chinese holdings of treasuries, for instance, could be part of the economic arsenal that we talk about. Is that something that you would see? Do you think all levers are available to be pulled?
Well, of course, and similarly, everything to do with critical raw materials like lithium, where China holds more or less 90% of the global market, is also on the table without being directly linked to the trade tariff. So I think this is what is at play right now, absolutely.
You mentioned just a moment ago, just very briefly, that Europe is divided. Nuru Rubini was telling me earlier on there's a possibility that Europe could break into two groups of whether or not it supports the United States or China. How big a risk is that?
I'm not so sure there's going to be such a breakup. I think that we'll have to find a new kind of policy that is strong enough and not just, a lowest common denominator, given that, again, the EU has to really get on with massive investment, has to show that it can attract international investors. So you can't do that with a lowest common denominator policy. So I don't think it's about the split, as more about finding a really new consensus, economic consensus for Europe. I think the split is more vis-à-vis Russia, where you have a risk that some countries are going to run for cover if the US is disengaging from the security and defense of Europe.
Fabrice, great to catch up. Thank you very much indeed for your analysis. Fabrice Pothier, Chief Executive of Rasmussen Global. Let's talk about what is coming up on Bloomberg. Anne-Marie Hordern is going to be speaking to the US Treasury Secretary, Scott Bessent. That conversation is going to be taking place, we think, in Buenos Aires. It's going to come a little bit later on. We are looking forward to hearing what he has to say. Really looking forward to how he is reordering the global economy and his kind of brief around that. Anyway, that conversation is coming up on Bloomberg. Equities are broadly higher right now, but it's going to be a bumpy session, I suspect, once again. Anyway, Danny Berger's next. This is Bloomberg.